my name's Joe Roche. I'm Engagement Manager at FinTech North. Thanks so much for being with us virtually today for the Borrowers on the Brink webinar. We're going to be doing a deep dive on all the latest lending and borrowing trends. So really looking forward to this one. I'm just going to share my screen and just explain a little bit, firstly, about the work that we do at FinTech North, if that's okay. So hopefully everybody can see my slides. Want to say a huge thank you to the team at Lenvi, to Will, to Faye, to Laura, to Sam, to everybody who's been a fantastic supporter of FinTech North. It's been an absolute pleasure working with the team. Yeah, they really do provide a unique insight into this space. So we're privileged to be working with them on this webinar, and indeed as strategic partners across the year this year. So I just wanted to start off by saying that. So yeah, as I said, my name's Joe, and I work as General Manager at FinTech North. So it's my privilege to bring you all together as part of our fantastic FinTech community. And of course, today we're virtual. So yeah, we can all come together, not in one place, which is awesome. For anybody who wants to reach out to FinTech North, please note the email address there on screen right now. We're always keen to collaborate with like-minded organizations. We've got loads of speaking opportunities, sponsorship opportunities, general opportunities to get involved, which I'll talk about shortly. So really quickly, who are we? What do we do? Well, FinTech North was set up back in 2016 as the first ever regional hub for FinTech outside of London. It was a collaboration between two organizations, Whitecap Consulting, who are a regionally based strategy consultancy, and White Label Crowdfunding, who are a Leeds-based fintech. And it was really set up as a response to London centricity within the UK fintech economy. It started life as a one-day event back in 2016, hosted another event in 2017, and in 2018, we expanded over to Manchester with conferences, started running special interest events. In 2019, we expanded over to Liverpool and up to Newcastle with conferences, and really became a pan-Northern organisation at that point. And where we are today, FinTech North really, I suppose, is the focal point for fintech in the north of England. We exist to bring our community together, but we also exist to promote the north as a centre of excellence in fintech. So that pertains really to work that we do nationally and internationally, talking about all the great innovation that's happening in places like Leeds, Manchester, Liverpool, and Newcastle. We're here to develop the sector in the north. What does that mean? That means providing connections, introductions, but also profile opportunities for northern entrepreneurs, startups, scale-ups. It also means that we try our best to develop the sector in a neutral way. So we don't promote any one city or geography as the sort of payments capital or lending capital or whatever it might be. We try and promote the north as one region because we believe that means we can differentiate ourselves on an international stage. We're not a membership body. There's no cost attached to being part of FinTech North. Most of our events are free to attend. And actually today is our 121st event since we started back in 2016, which is awesome. This graphic kind of really visualizes everything that we do. And I think the key thing to point out here is, well, two things I always like to point out. Firstly, our community is generally a senior one. You're a knowledgeable bunch, certainly far more knowledgeable than I am when it comes to fintech. But yeah, that makes for some excellent conversations when we bring you all together. And I hope that you all get involved today and post some questions in the chat and get involved in the poll and things like that. The other thing to mention is we're entirely self-funded as an organisation. So we rely on the support of like-minded organisations to come on board, take a partnership, and support us in the work that we do. And some of those organisations are on screen right now. And obviously, I want to say a huge thanks to all of our partners for doing everything that they can to support our community in the work that we do. Really quickly, I'll just give you an idea of what's going on in the north, and I suppose the size of the sector up here as well, which is really important to know. FinTech in the north is definitely a significant ecosystem. It's internationally significant. Out of about 2,500 FinTech firms across the UK, we've probably got around about 400 of them here in the north of England. The sector in the UK generates about 11 billion GVA every year for the UK economy, and in the north, it's generating about 2 billion. So it's really sizable when compared to other international hubs around the world. And if I just take you on a bit of a tour from west to east, in Liverpool, we see real strength there in wealth tech and insurtech. As a proud northerner, I'm always really interested to hear that these specialisms kind of relate back to that particular city's, industrial heritage, past prosperity. So obviously Liverpool as a port city, well versed in handling assets and wealth coming through the city. Greater Manchester is obviously a thriving tech hub, has a real strength in payments and e-commerce. Some really well-scaled companies in Manchester. I think it's home to about 7 unicorns, and some of FinTech's sort of instantly recognizable names like Starling, Adyen, and Klarna. Over in the Leeds City region, which is home to FinTech North and home to Lenvi as well. There's some really interesting developments over here. We have a real specialism in Leeds in banking, lending, and regtech. I'm sure some of that's going to come through today. Leeds has recently become the home of the FCA and the Bank of England, who have both opened offices here. And I mentioned that regtech specialism. I think that's very much linked to our sort of past position as a kind of legal and financial centre, definitely. Leeds is also home to all the major credit reference agencies, and that's the only city in the UK outside of London which can say that. So that's TransUnion, Equifax, and Experian. Up in the northeast, there's an emerging sort of payment specialism and a bit of an innovation corridor between Newcastle and Durham. Again, home to some really well-scaled fintechs like Atom Bank in Durham, one of the best-known challenger banks in the UK, and Sage as well, who are sort of well known for their accountancy software based in Newcastle. Some innovative payments firms in the region as well. Canny, as a company that we've worked with extensively down the years, and BottlePay, and there's a few others as well. So yeah, just want to give you a flavour of kind of what's going on in the north. I could talk for days on all of this stuff, as you all know, but I think it's always useful to kind of contextualise what we do in this sense. Just really quickly on FinTech North at the moment, we've been doing some strategy work recently, and we as an organisation have been well known for hosting good fintech events over the past few years. But this year, we've seen some organic growth, I think, partly down, I think, to a renewed national interest in what's going on outside of London in our sector, which is obviously great to hear given our reason for existence. And that's given us a little bit more of a focus this year on a few other areas. So I just wanted to touch on some of those really quickly. International trade is one of those areas, and fintech skills is another area as well. So I'll expand on some of that stuff recently. But that's not to forget our events. We want to run bigger and better conferences and events, and Ryan and Rachel and the team are doing a fantastic job of bringing you all together, and we'll continue to do that. And as you can see from this slide, we've got absolutely loads planned. So the guys will be putting some more information in the chat later on as well on some of these events, and hopefully we'll see you all soon, either virtually or in person. Just quickly on the international trade point, we want to make more trade missions happen in the north of England. All too often, international visits might not leave London. And we want to do something about that. We want to make sure that more missions come to the north, and vice versa, that northern companies are more aware of what's going on in other markets, and that international expansion is very much part of their roadmap as well. So we've got a live opportunity at the minute for organisations to join a delegation to Money 2020 in Amsterdam, and we'll be hopeful of making more of these things happen in future as well. So very much a case of watching this space. And finally, fintech skills. I think this issue is very much linked to other challenges in the sector. Things like diversity, for example, that's really important to us at FinTech North. All too often, we're hearing from people in the early stages of fintech careers. How do I get the right skills? What skills do I need? Where are the internships? Where are the apprenticeships? How do I get jobs, basically? And similarly, the employers are kind of saying, we're struggling to find people with the right skills in fintech. There's not a sufficient supply of skills into the sector. So we've kind of done a bit of soul searching, and we thought, we're hearing this all the time. We want to do something about this. We're not a training provider. We're not going to be able to provide the solution to this issue, but we certainly know the organizations that can help. We know the employers, we know the FE institutions, we know the universities, we know the policymakers. So why not bring the right group of people round a table to positively impact this issue? So in the short term, we've set out this year to run more skills-focused events, and our Leeds conference coming up will feature a panel on skills. But we also have created a Northern FinTech Skills Steering Committee as well. And we've also got a series of skills partnership packages for organisations to come on board and help us impact this agenda as well. So again, if you're interested in supporting us with this, we'd absolutely love to hear from you. We think it's a really important issue, and one that we hopefully can impact in a positive way. So I'll leave it there. Just always good to give a bit of an intro to FinTech North. We always have people who are joining for their 50th event, but we also have people who are joining for their first event. So apologies to those who've heard me do that a few times, but it's always important at that point. So I'll stop sharing my screen, and I think at this point I'll hand over to our first speaker. So Will, if you could join us on the virtual stage, please. And yeah, the floor is yours. So please introduce yourself, introduce Lenvi, and tell us all about the borrowers on the brink.
Perfect. Thanks, Joe. Can you see my screen, and can you hear me, Joe?
Yeah, we've got that. That's perfect, Will.
Perfect. So good morning, everyone, and thank you for joining us today. I'm Will Ellis. I'm Chief Revenue Officer of Lenvi, and I'm delighted to have the opportunity to share Lenvi's 2024 research with you all, where we'll be delving into the key findings of our latest annual report on consumer attitudes towards borrowing. So for those of you who are new to Lenvi, I'll briefly introduce you to who we are and to what we do. So Lenvi is a fintech specializing in B2B consumer and commercial lending software. It combines global expertise, market insight, and end-to-end services to provide loan management software, risk management software, mortgage and loan servicing, standby servicing, and know your customer software. We're also headquartered in Leeds, and if you'd like to learn more about Lenvi, I'd be delighted to connect with you. So please do get in touch. So amazingly, we've been running our research report for the last 10 years. In the past decade, our annual reports have provided invaluable insights into the borrowing landscape. And since 2013, we've been surveying around 2,000 UK consumers per year, and we've been getting the attitudes and really getting the feel about borrowing. So we asked them a range of questions. They cover topics from mortgages, attitudes to debt, financial education, green and ethical lending, and much, much more. And from their responses, we compile a report and we share it with our community, our customers, and our industry. With this data, combined with our in-depth knowledge and the understanding of the trends and the behaviour, then we're able to make summaries and predictions alongside our data and provide these tangible insights into the market. So if you'd like to read the report, we'll make a link available at the end of the webinar. But why do we do this report, and why do we keep doing it? Well, to be frank, it's because it's really interesting. Year on year, our data never fails to inform and surprise us. It gives us key nuggets into what's driving consumers' decisions, and then what we can learn. And then this drives our innovation pipeline, allows us to be able to share subject matter expertise with the market. And back in 2013, when Lenvi first created this annual report, Apple was only launching its iPhone 5, and we were foreseeing the rise in mobile banking. So times have changed considerably. This year's findings are particularly compelling. They point towards one resounding conclusion: the urgent need for collective action to support borrowers in making sound financial decisions. And this is something we can all get behind and work to improve through our services, our technology, and an industry. One of the key themes of this year's report highlighted the pressing need to assist vulnerable borrowers. And I'm delighted that today we're joined by a panel who represent companies making waves just doing this. So thank you for your time as well. No longer confined to specific marginalised groups, vulnerability can strike at any moment, propelled by sudden financial shocks, such as significant increases in housing costs. And while financial literacy cannot prevent every setback, it equips individuals with the tools to navigate financial challenges effectively, empowering them to manage their money wisely and secure their well-being. But we're going to come back to that. So when consumers borrow money, they don't just wake up and think, today I fancy entering into debt. They borrow because they are focusing on an end goal: a car to get them to work, or a holiday to get them from work. People borrow money to pay for many different things, some of which might be considered more traditional reasons to borrow money than others. Here we found the majority of people borrowing for a car, which seems reasonable. To caveat this, we offered our consumer a pre-populated list that did exclude mortgages, with a range of borrowing options, but this gives an insight into their behaviours. More concerning is 14% said they are borrowing to pay for a bill. This rises to 24% in 18 to 24-year-olds, and we found 12% are borrowing to pay for food. With increased energy prices and high inflation, we can see the effects of a high cost of living taking its toll. Further on in the research, we found more than a quarter, 29% of people said they borrowed because they couldn't afford to make an outright purchase and urgently needed to. This year, we also asked questions about how people treat borrowing for some of the less traditional items and found varying opinions on what people considered essential. 19% of those 18 to 24-year-olds were borrowing to fund a more aspirational lifestyle. We also looked at those borrowing for IVF treatment, cosmetic surgery, and spray tans at 2%. What we found is a hugely varying attitude to what was considered acceptable borrowing, and this is something lenders need to consider. This year, we found borrowers tend to have two main priorities in mind when they're choosing a lender. Low interest rates, reflected by 39%, followed closely by brand reputation at 39%. Now the impact of interest rates will come as no surprise, but waiting on brand was interesting. Digging a little deeper, we found the next generation of borrowers. 47% of 18 to 24-year-olds said brand was a crucial factor when considering a lender, compared to 20% who looked for interest rates. Brand is what makes one lender stand out from the next. It can be a very human element to a business, and deeper understanding of the individuals you're serving can lead to improved brand loyalty and better customer outcomes because you're delivering an experience users expect. Consumers demand seamless and efficient transactions, and companies that can deliver on this expectation are poised to thrive. So how do we do this? Leverage data to understand users. We found that 65% of people would consider giving a lender temporary access to their transaction history if it could lead to a more personalised rate. The growing adoption of open banking is helping consumers reassess how they share data and could support the widened access to existing products like credit and debt advice. For those with a thin file, open banking may also create opportunities to access funds that they were previously excluded from. The key here is trust. Lenders need to be transparent with who they share data with and what the process involves, reshaping consumers' perspective. Harness the tech. Analysing big data with AI can enable consumers to have a borrowing experience that truly understands and addresses their unique needs. By leveraging a deeper understanding of vulnerabilities, lenders can design inclusive financial products and provide compassionate and comprehensive support to vulnerable customers, thereby strengthening customers' relationship and increasing brand loyalty. Offer human-centric experiences. 21 of those we asked wanted to speak to a lender. When the economic landscape becomes uncertain, it's unsurprising that consumers look for a more human-driven interaction that makes them feel secure. They want to trust their lender, and they want a little hand-holding through rough times. AI can support this experience in a variety of ways, offering round-the-clock assistance and delivering human-like quality of information. Whilst the more mass adoption of ChatGPT has heightened users' acceptance here, so too has everyday exchanges with Siri or Alexa, giving understandings to voice assistants for telephone applications. Understand what's driving them. Almost half of those who were asked, 49%, would be pleased to see green lending innovations such as lower loan rates tied to household energy efficiencies. 2 in 5 borrowers say that a lender's green credentials are important when it comes to taking a mortgage or of a loan. We see green lending very much as an area of growth, offering a huge amount of differentiation within the market when done well. As an industry, we know there is no ignoring the rapid adoption of buy now, pay later services, allowing consumers to split purchases into manageable installments, often interest-free. With buy now, pay later included in credit reporting, consumers and lenders have a clear view of financial health. It can possibly impact financial inclusion and promote wider access to credit. Going back to our findings on brand, user experience here is key. This is a friction-free lending at best, as Buy Now Pay Later offers a seamless UX with ease and convenience. And for lenders supported by the right software, this growing market offers an opportunity for extra revenue streams. But the responsible application, Buy Now Pay Later, is key here. Half of UK adults are unaware that Buy Now Pay Later is an unregulated product. A report from Citizens Advice published in 2021 showed 39% of people who had used Buy Now Pay Later in the last year used it without realising. 40% thought Buy Now Pay Later wasn't proper borrowing, and 42% didn't understand what they were signing up for. It's a balance. There is more to be done here in financial education, ensuring consumers know and what they're entering into, and dare I say, adding a little friction back into the process. And firms need to get ready for regulation because we know it's coming, and by working with partners who understand the implications well. It's probably no surprise to the audience to say that consumer vulnerability is on the rise. What we're seeing increasingly is the face of vulnerability is changing. The economic landscape in recent times has been a stark reminder that so few of us are truly resilient to financial shock. FCA's consumer duty requirements highlighted the importance of supporting customers, particularly those who are considered vulnerable. What we're seeing is vulnerability transcending from marginalised groups into broader society. To be frank, we're all potentially vulnerable, and lenders should work with this front of mind, and it's estimated nearly 60% of the UK don't have emergency savings to cushion a financial blow. When it comes to mortgages, our research revealed 59% of people are concerned about finding an affordable rate when their current deal comes to an end. 29% of consumers borrow money because they can afford the outright purchase of a good and urgently need to. A quarter of people are borrowing money to make month-to-month costs more manageable. Clear here that being able to accurately identify vulnerability and key indications is crucial for lenders going forward, supporting customers easily and quickly through temporary arrangements while conducting in-life affordability checks on agreements. So, what's the key takeaways? What we wanted to do with this report was paint a picture of changing borrowing habits and give useful, applicable insight for our market. Our key takeaways include custom integrations and open APIs can vastly improve a lender's offering and user experience. Financial inclusion and financial literacy go hand in hand, so fintechs need to use technology to deploy as many data sources as possible for those underserved to be able to access finance. But it's crucial to recognise that technology alone is not the answer. We know customers are seeking closer relationships and the human touch. Striking the right balance between these elements will be the key to success. I'm going to now hand back to Joe, who's going to bring in the panelists.
Awesome, thank you so much, Will. So much there to kind of dig into with our expert panel now. Some things that were really jumping out at me there, you know, the need and the requirement to actually borrow to pay for more mundane things like bills rather than, you know, historically sort of bigger life events. The importance of brands, you know, green lending as a growth area, and then the regulatory side of things as well with the sort of, yeah, not only buy now, pay later, but that changing face of vulnerability that you mentioned. So yeah, can't wait to get stuck into this. Thank you so much for that presentation and for all of your support, and also to the team at Lenvi as well for all of their help. So I'm going to introduce our panel now, and if everybody could kind of come onto the virtual stage and join me on screen, that would be awesome. So joining the discussion with me now, we've got Simon Padbury, CRO at Canafin. We've got Sutherland Boyd, COO at Plend. We've got Sam Goodacre, Director of Product, also joining us from Lenvi. And we've got Caroline Fowler, and Caroline, well known to our community, your Director of Product and Pre-Sales for Consumer Interactive at credit reference agency TransUnion. So thank you all so much for taking the time to join us today. As I've said to you when we've spoken before, like, I really hope that these discussions are a chat between you guys, our subject matter experts. So really keen for you to give your views on some of what we've heard today and some of what you're facing on a sort of everyday basis, and what you're seeing in the market as well. So I'll just kick things off then, if that's okay, and I'll start with kind of one of the sort of first observations and insights from the report, which was all around open banking. So what is the potential impact of open banking when it comes to lending and borrowing, and what are the best use cases? And Sutherland, I'll start with you if that's okay, if you want to take it away.
Yeah, sure. Thank you. Yeah. So so at Plend, we're an open banking driven lender. And our mission is to level the playing field, making sure that everyone's got a chance to access a loan that they can afford. And just to give a bit of context in terms of our push for open banking, is that our founder started our company because he wasn't able to access credit due to previously being in a DMP, despite working at one of the big four on a good salary. So I think, yeah, the impact of open banking is massive when it comes to both lending, like from the lender's perspective, but also from a borrower's perspective as well. So from a lender's perspective, it allows us to lend to the previously, or what we're seeing now, the currently financially excluded. It gives us 12 months of transaction data. It gives us a deeper insight into the day-to-day activity of a borrower. So we do still use credit reference agency data as well, but it means that we can kind of align those two and see potentially, blemish on a file from 5 years ago is no longer impacting their day-to-day affordability or how they're using their funds going forward. So it allows us to really accurately assess risk alongside breaking down affordability, categorizing all their transactions into separate items, and just really being able to confidently lend to customers. That means that we can offer lower APRs, and particularly for borrowers as well, it broadens the scope of the lenders that they have access to. So we're seeing a lot of people being pushed out of mainstream lending. And so lenders like us that are offering open banking give borrowers more opportunity to apply and, in our case anyway, get approved for loans. So I guess the best use cases is the ability to provide credit to those who have previously been excluded, either due to lack of their credit files, so new to country, or blemishes on their files, potentially also inaccurate data. It can be difficult to get it, corrected as well. Also, just the ability from a lending perspective, we can also use open banking to check in on borrowers throughout the lifetime of their loan. It's great for loan reasons such as debt consolidation. We can check that are those loans actually being used to pay off those debts, and that helps us in future to accurately assess risk going forward.
Awesome, thank you, Sutherland. Does any of our other speakers want to jump in and talk about open banking from their perspective? And much like Sutherland did, if you just want to expand a little bit on your organisation and give a bit of perspective, that'd be great.
Absolutely. I think from our perspective, completely support what Sutherland says. I think there's so many opportunities with open banking data, because it does give that richness of information in terms of being able to support alongside traditional data in terms of the credit reference information that we have. It provides that additional lens. It supports being able to qualify and ensure current account turnover data is accurate as well. So from that perspective, it gives that richness. And from a financial inclusion, on our side, it's something at TransUnion. So I work within the consumer team at TransUnion. So we work through a network of over 40 partners to provide credit education. But what we do see is, there's some people who aren't able to access their credit report and information, and that's because they're potentially credit invisible. We've identified there's approximately about 5.5 million people across the UK who could potentially be credit invisible. It could be that you're new to country. It could be that you've never had a need for credit. It could be that you've just come out of prison or a long time in hospital. It could be a number of reasons. Recently divorced. Lots of reasons why you potentially could be invisible. And open banking, it enables those consumers, to have ultimately to be able to provide their transactional data and I suppose gives them that empowerment. So I think some fantastic opportunities. It's TransUnion's working with a third party called Bud at the moment, in terms of to look at how we can bring that data into the organisation and help the clients that we're working with.
Rather boringly, I'm going to have to agree with everything that's been said so far already. I'll just offer the perspective from a startup. So I'm Simon. I'm the CRO of Canafin. Canafin is a new kind of startup green lender. Later this year, we're looking to launch kind of a brand new innovation, which is called a carbon linked loan, where we actually reduce APRs based on the carbon abatement of a lending activity. Just with regards to open banking, I guess the only thing I would add, and I guess hopefully offer a slightly contrarian view from our perspective, our judgment, and we could absolutely be wrong on this, is that bureau data actually offers probably a better foundation on which to launch our business in particular over open banking. But we are very much excited about the prospects of open banking, and it's actually kind of a key part of our day two kind of rollout strategy. Specifically, the vast majority of our customer base, UK homeowners predominantly, they have a credit profile, and so the bureau data gives us that natural launch pad. But we view open banking as a good addition to kind of capture the small proportion of customers that perhaps only have a thin credit file. So as a tool to augment and to enhance a bureau strategy, we see enormous potential.
Yeah, I think that's really important. Morning, everyone. I'm Sam, Director of Product at Lenvi, and I'll not do the Lenvi introduction because Will's already done that, but I lead our product and engineering and service delivery teams across Lenvi. And from a loan management perspective, I think it's really interesting that point you touched on there, Simon, about the augmentation of the data, and very much seeing the use of open banking data and the traditional bureau data, creating a holistic picture of the borrower. And that helps both from an origination point of view, but also from the ongoing life of that borrower. So checking their income and expenditure through the life of the loan, it gives you kind of immediate ability to react to income shocks or expenditure shocks that borrower may face. And that leans very heavily, obviously, into consumer duty and making sure that we are doing the most that we can do for the borrowers. So I think open banking's got huge potential. We talk about the transaction history, but there's also the payment side of it as well, and pay by bank, and maybe we'll touch on that a little bit more as we go through. But I think as the adoption of open banking increases, it kind of provides a number of benefits across various areas.
Thank you, Sam. And we've mentioned how new technologies like open banking can revolutionize this space, and we've touched upon data points there as well. I don't think we could mention data without mentioning AI as well. Is there an impact that AI is having in this space? Does anybody want to talk about that?
I could probably kick this one off.
Yeah, please do, Simon.
The way I'd frame this is, I think there are both opportunities and risks. So in terms of opportunities, I mean, the obvious one is in risk profiling of customers and how you can potentially use AI to infer relevant data from the open banking process. However, I think other avenues also exist. Unlocking other forms of revenue, to change a typical lending equation and offer lower APRs, I think is a really interesting one. AI could, if used intelligently, could also help kind of unlock, some of those kind of business models, for example, targeting advertising to certain consumers. I think Zilch is the obvious example there. There are risks. Obviously, I think it has to be used intelligently. I wouldn't be surprised if we see some instances where the poor application of AI, specifically within customer service, actually devalues a brand. The classic application of AI, if you like, is the use of LLMs to create better economics within the customer service function, using bots. I'm sure we're aware of that. But we know, especially from the report, that a good portion of customers actually prefer the personal touch. So there's an interesting tension, I think, that exists there.
Yeah, I think there's definitely work to do to make sure we get that right. I mean, we had the session last week with FinTech North on vulnerability, and we were talking around, you know, the data that's available through transactional data, through, you know, data that's been contributed by consumers directly. We were talking about the Vulnerability Registration Service, VRS, in terms of being a great source of that information. But with all that data, you know, things like dwell time as well in apps, and, you know, information that the lenders collect as well. With all that information, it's really important. How do we use that? How do we create those personal journeys? And absolutely, AI has got a role to play. But it has to be done in the right way in terms of ensuring that that message going back to the consumer experience, the consumers having a good customer experience, and it's personalized in the right way. And I think that's something that's, you know, we have to watch to make sure that we get that right. But I think lots of opportunities there, and you know, ultimately, I think there's you know, some great opportunities as we work through.
Yeah, we use it in a couple of instances, obviously, in our classification of our transactions and things for our lending system as well. But yeah, also in the customer service aspect, we've tried, yeah, bots and things every now and then. But I think what we've kind of come across as a business for now is definitely like use of it with manual oversight. Because yeah, I just don't think it's at a stage yet where it's, you know, you really want to just let that run fully on its own, especially on the customer service space. We've actually taken it off and have just gone, you know, our live chat is just my team, because that is that more, especially with the vulnerability in the space that we're in. The human approach is much more wanted.
I think you're right, that human approach, that manual oversight, the human interaction is still desired and greatly required and part of that overall process, isn't it? But I think we'll see kind of the use of AI adoption continue to increase and find more use cases for it. But I mean, I find it really interesting. We all kind of have poor experiences with chatbots today, don't we? And it really does turn you off from that brand and that experience. So I think it has to be used with caution right now, but still so many exciting opportunities for the application.
And I think, you know, if you can get the flow of conversation, you're responding to consumers in the right way, it can work fantastically well. But I'm sure everyone on the panel has been caught in a loop where you're just not quite getting the information that you need, and you feel like you're getting stuck there. And there has to be then an alternative route, whether it's, you know, to speak to someone directly. And I think that's what's really important to be able to offer. So when it's working right, you can have a really fantastic experience. And equally, I've had some brilliant experiences across some of the you know, the financial institutions that I bank with. However, I've also had, on the flip side of that, some pretty poor experiences from across, you know, multiple different sectors as well, where you just can't get to the information that you need, and you feel at that point a little bit stuck. And I think actually we, as a sector, we're actually doing really well in this area. And I also think Consumer Duty kind of highlights, you know, making sure that consumers are getting those good outcomes. So there's a lot of focus and attention on this at the moment.
Just to jump in here, if any of our audience do have any questions for our speakers, please feel free to post them in the Q&A in the chat, and we'll try to get to them at some point. Reputation and brand has come up a few times already in this conversation. So Caroline, maybe starting with you, you know, how key is that? How important is reputation when it comes to fintech, financial services, and of course lending?
Yeah, and I know this was something that was called out in the Lenvi research as well. So at TransUnion, we've done reports in the past which has looked at, you know, how important is brand reputation, and we found that actually 43% of UK consumers cited trust as being the most important factor when choosing a finance provider. So it's absolutely critical that the consumer has that good experience right from the outset. And I think some of the conversations that I've had with some of the organisations that we work with is that that needs to start right at the beginning. So if you are in a situation you're potentially declining a consumer when that's their first experience of your brand, it's really difficult to ever rebuild that relationship. So that's something that then, you know, particularly with Gen Z, if that's someone starting out initially looking for maybe a loan to buy a car, I think that was one of the top things, or you know, to fund another purchase. If the relationship there is a decline or a poor consumer experience, it's really, really difficult to get that relationship back on track to them, to, you know, to potentially support them with future borrowing. There are options, I think, and being able to offer other products and services at that point in time to kind of build that relationship. So we're working with a lot, 40 plus partners, offering things like credit education, access to credit report free of charge. You know, what we've found is what's received really well is a service called Credit Mentor, where it pulls out the information in that individual's credit report, and it serves up, these are the top things that you need to be working on. Here's the next kind of best action that you can take to improve your credit score. And I think where brands are able to offer, whether it be, you know, credit education or other ancillary services alongside the kind of traditional lending products, they can build those relationships, they can have that strong brand trust, so that it makes for I suppose an easier conversation if the consumer is applying for other products and services that they may not be eligible for.
I'd offer a kind of a slight provocation here, if you like. I actually think in the UK we're fortunate that we have quite a high bar for what qualifies as a good reputation. You know, so whether it's lending or financial services more broadly, I think we actually have to deliver extensively beyond the core product to be able to acquire and sustain, actually, to be able to acquire and sustain a positive reputation. I think the FSA, you know, deserve a lot of credit for that, but so does the competitive ecosystem that we have here in the UK and all those organisations that support that. And so the natural extension of this is that reputation is a good barometer, you know, for the health of the ecosystem. And if you can get by with a poor reputation, there's obviously, you know, symptomatic of weak competition. But yeah, certainly orientating the business model around the customer's interests is key to getting the trust and obtaining that reputation, which in turn gives us the broad and an educated customer base to access. And yeah, I'd say consumer duty is central to that cycle.
Yeah, I think similar to Caroline, I think we do a lot of work on the decline journey, because fully agree with everything that Caroline said about if the first interaction is a decline, then that's never gonna, how are you gonna build from there? And so I think, yeah, signposting, referrals, similar to TransUnion, we work with a lot of agencies to try, if we can't assist, then here's your next route. This is not the end. Sorry, and we use quite plain language as well, like, sorry, it didn't work out. Happy to, relook at this in 3 months or something. But in the meantime, here's some other avenues that you might be able to go down. Work with things like Invest to kind of highlight benefits that they may not be getting, kind of all goes into, I think, yeah, one of the things from the report is, and as Will said, like, we are all potentially vulnerable. So it's kind of, I think the attitude around signposting and things as well is changing. So it's just merging into vulnerable customers. But I guess there was maybe some taboo about signposting because then you needed help, but actually the cost of living crisis, the current economics that we're in, we all need assistance. So it's no longer a bad thing to be like, we can't help you, but here's who else can. And I think it just kind of, it's not a firm end to the journey, I think is really, really useful.
It's a really important piece, isn't it? It's like you say, it's not a firm no. Like, it might be a no, but it's a no because of X, Y, and Z, and to resolve X, Y, or Z, these are the people or the agencies that can help you with that. And I think one of the things we've seen from consumer duty is, I mean, from our perspective, it's more one kind of in life, but it's providing clear communications that are understandable, and that does extend to the origination journey as well, doesn't it? To say, right, well, okay, this is the reason why, and this is what you can do about the decline or the refer.
I think also just on that as well, like, I think even if it is an acceptance, because using plain language and stating very upfront, this is for our perspective, this is the rate that you're going to get charged. This is your monthly repayment. These are how you can adjust through the lifetime of your loan. Customers knowing that upfront before they sign up in plain language, I think, is very key for the brand as well. Because if customers get into, issues down the lifetime of their loan, we can refer to that, but also offer flexibility and things like that. But the more they know upfront, the more they feel confident going in, because obviously customers are, you know, they're needing it for bills at the moment. And so it might not be that they have a day to kind of sit down and process and look at all their options. They might just be going for what they can get. And so to present as much as we can upfront in a way that customers can identify. And yeah, Consumer Duty's done amazing work for that, making that the level playing field. I think it's great.
I suppose it all comes back to that empowerment, isn't it? It's empowerment with the right information up front. It's empowerment with the right understanding of how the credit ecosystem and your credit information works. And equally, it's empowerment at the end. If it's not, if you're not able to be accepted at that point in time, what are the next steps? What can you do? Where do you go from there? At each stage, it's like, rather than just the end of a journey or not necessarily getting the information you need, it's empowerment through information and education.
Yeah, and I guess well, I'm sure we're all looking forward to the reform of the CCA. That's an intention that the UK government have stipulated to look at it, isn't it? But obviously, with the changing landscape of the government this year, I'm not quite sure what's going to happen. But that reform is long overdue, and I think there's huge strides that can be made with customer experience by reforming the CCA. And like I say, Sutherland, people haven't got a day to sit and read all of their financial loan terms and agreements, and quite often they just don't read them at all, do they? So that reform is really welcomed.
Just thinking about the current market then, obviously, you know, we're living in this cost of living crisis. How are your organisations responding to that? You know, and is it important to talk about things like, yeah, people who are struggling, universal credit benefits and things like that? Does anyone want to kick that one off?
There was a study recently that showed, I think it was in May 2023, by Policy and Practice, which showed that there was £18.7 billion a year, I think that's not claimed in benefits. 7.5 of that is on universal credit. So there's an enormous amount of people who actually could access additional funds across the UK who maybe just don't have that awareness that they're eligible for them. So I think there's an opportunity there, and there's some great companies that enable you to do that. To access it, to do a kind of a benefits check to see what you're eligible for. So there's opportunities there to support consumers alongside that credit education. As you know, yeah, absolutely.
I'd say, you know, we as lenders broadly and providers of credit, you know, we have an important and significant role to play in the overall health of the ecosystem, and I think that manifests itself in a number of ways. So inclusion is of course important, and leveraging technology to make, you know, more informed risk assessments of customers is key to that, and being able to kind of, you know, open up our customer base and make our products accessible is obviously important. Being there for customers as the macroeconomic cycle evolves is also key, you know, to ensuring that the business model, you know, is robust as rates rise and responsive as rates fall. At Canafin, you know, we're very much focusing on the all-in cost of property decarbonisation. So really trying to drive down, you know, those APRs by, you know, subsidizing, you know, with the carbon credit proceeds, that's one, but also offering short-term loans rather than kind of long-term subscriptions, and that leaves the upside of low energy bills, etc., to the customers.
Yeah, I think alongside Lenvi's report, we also do a financial inclusion report every year, and this year we've got the data from ours says is that 90% of the population felt impacted by the cost of living crisis, which is down from 94% last year, but also that 44% of adults, 41% said that their financial situation could improve if they were able to access a low interest loan. So I think it's that balance of, yeah, like Simon said, like ensuring that our risk and the loans that we are writing, you know, like we've done things like increase the buffer required and that kind of thing, just to make sure that affordability is obviously the most important thing, and thinking about it over the lifetime of the loan, not currently now, but, you know, if someone's life situation changes, if another pandemic does happen, taking those kind of things into account when we're making our decisions. But then, yeah, similarly, like Simon said, being there with our customers. So re-looking at how we can support customers through the lifetime of their loan and through the collections journeys, what we can offer, increasing our flexibility, just providing support, and going back to what we said before, signposting, financial education, all of that kind of thing.
That
think
financial
building up-
education piece. Oh, sorry, Caroline.
You go first, Sam.
Okay. That financial education piece has to continue through the life of the loan, doesn't it? It doesn't just start or stop at origination. There are different challenges along the way, and you have to maintain that education, and you have to do it in a clear and informative way. So whether that's if the customer gets into financial difficulty and needs some forbearance tools, you might apply breathing space, or being able to effectively change the repayment schedule or the repayment date, but doing that in a way that the customer understands, maybe ideally through self-service, but also providing that access to someone that they can talk to if they want to, and they can understand the impact of making those changes.
I think it's throughout a consumer journey as well. It's that constantly providing that education. So what, in the times where, times might be okay, actually building up that financial resilience so you are prepared for potential income shocks, and really promoting the benefits of that. And there's some great schemes. I think we were talking about some of them last week in terms of organisations that are promoting that. So I think, building that financial resilience in, making sure that there is a pot of savings or something there, so that if that you do have those income shocks, that there is some resilience there as well.
That's great. I mean, I think we've kind of touched on it a little bit already, but I was just going to jump in and ask, are we getting the education piece right? Obviously, like financial inclusion, something that we care about, but is there more to be done there? Does anyone have any thoughts on the education side?
I think there is.
Go on, you go, Caroline.
No,
Your turn this time.
I was just saying, I think there's some of the brands that we're working with are doing an amazing job, but there's absolutely still more to be done. I think in terms of increasing that reach, we've spoken around before around credit invisibles and people who are falling outside of the financial ecosystem, making sure that we are contacting those, looking at what we can do. We had the market study obviously came out at the end of last year, which talked around, how can we make this education and information more easily accessible, working with organisations like Money Helper. So absolutely still more to be done, and there's still a lot of common misconceptions, I think, around credit and borrowing, and I think there's opportunities for address those. So huge potential to address that. Some great work already been done, but yeah, absolutely more that we can do. Sorry, Sam, go ahead.
No, I completely agree with what you were saying, but I think it goes further than that as well. And I think from my perspective as a parent of young children, I don't see that financial education piece coming through from the schools. At the moment, the education system, I think, kind of relies on parents and other people to provide that financial education. And for me, it should be a key part of the curriculum. It's as important as understanding the fractions as it is to understand, well, what does it mean to borrow? What does it mean to pay a loan back on a monthly basis, or a mortgage, or what does buy now pay later mean? These things should all be understood by children, because the children become young adults, and if we don't start at an early age, it just falls on the industry, which is right to a certain extent, but the industry alone can't do everything.
I think that was actually a question that was asked recently. Well, I'll say recently, it was back in the summer an event at the Centre of Social Justice around, are we going to see any changes to add that into the curriculum? And I think the answer was, at the moment there's so much pressure in terms of what's included, it's unlikely, but that they are looking at the industry to kind of provide solutions, and there are some good solutions out there, things like Go Henry, I think NatWest with their Rooster account. There are some kind of good engagement with young people, but absolutely they're the kind of things where I think there's still some great opportunity to look at what can be offered in that space, and how to improve the education of young people. And we ran a program where we were going into universities and running kind of webinars and sessions, going through what are credit reports, how do credit scores worked, and some of the questions, I was talking about those misconceptions, some of the questions that we were being asked from students did show that there is a lot of misunderstanding about how our industry works. So I think there's still some great opportunities in terms of how do we connect to younger people, to students, and make sure they understand how they can set themselves up for success in the future by putting in some good behaviours and practices right from the outset.
Yeah, and I think we look at the stats on buy now, pay later, the amount of people who are borrowing on buy now, pay later and don't understand that they are actually entering into some sort of financial transaction, and it really highlights that point.
Just I've got one more question on vulnerability, and then I'm going to get to some of the questions in the chat, because I can see we've had some great questions. I don't just want to leave them to the end. We might get a few more if we tackle some of those. But just before we do that, then, so obviously with vulnerability, identifying, detecting, predicting, supporting consumers here is key. But we've spoke about that changing face, I think is the phrase we use, the changing characteristics of vulnerability. Does anybody want to sort of jump in here and tackle that? Maybe Sutherland, Caroline, anybody want to jump on this one?
I mean, we were talking about it a lot last week as part of the event that we held. So for me, to be vulnerable is the opposite of empowerment. So for whatever reason you're unable to protect yourself from harm or exploitation, it could be that you just don't have the tools or information needed to protect yourself. I think the stat that came from the FCA that was 56% of the UK are vulnerable at some point, and that could be for such a broad number of reasons. It could be mental health, it could be a really temporary situation like a divorce, or potentially that you've been a victim of crime or a victim of fraud. It could be it could be linked to your age. So I think it's around kind of in response to that. Some of the themes that came out of the session that we were talking about last week was again data. So how do we as an industry make sure that we've got the right data and information to be able to identify those vulnerabilities? And I think that is something that we're already solving for as an industry in terms of with the information that we collect. For me, the biggest challenge is how do we take that data and use it to respond in the right way? And we go back to, I suppose, the conversations that we were having at the beginning of this discussion around AI. How do you take what is an enormous kind of an amount of data and ultimately use that in the right way, so you put in the right treatments and that person feels like they're being responded to in the right way, and ultimately you're catering to their needs. And I think that's the bit that's difficult to get right. And if you think about the sheer volume of people who could have a vulnerability, how do you get that balance right between providing that support from a consumer perspective, whilst also balancing the kind of interests of the business and ultimately the organisations, and being able to protect the organisations that we work for.
Yeah, and I think that's absolutely correct. And I think also, just like feeding in from what Sam was saying about AI and that kind of thing, I think that's where, as businesses, as firms, we've got to be smart in terms of how we do find the right user cases for things like AI. So if we can get it right for the general, for the standard, I guess, journey, which allows, we offer different routes for, different pathways for vulnerable customer journeys and things like that, so that the team, we can have humans on those, particularly while we're sussing it out for, potentially, obviously, in the future, we can broaden the scope of AI and it can be used. But I think, yeah, I would personally want humans on those journeys for quite a while yet. But yeah, that kind of balances the business and the customer aspects, because if we can have AI and things like that, keeping the business ticking along, helping the customers that need self-service, all that kind of thing, with their general queries, and then we can really have that human-centered approach on the vulnerable journeys. Because I think across we are seeing like an increase in mental health, life events, vulnerabilities as well, which, yeah, like Caroline said, can be temporary. So, it's a dip in and then dip out. But yeah, I think it is just the support that we can offer. Yeah, and how we do that.
I think. Sorry, go ahead.
No, you go first, Simon.
No, I was going to say that's a really good point. You when it comes to vulnerability, you want the personal touch to kind of offer to those customers. But I think AI could really serve us well to help identify vulnerability in the first place. Identification is the real challenge here. Vulnerability doesn't always have a label, or is indeed easily identifiable. My mum is my barometer here. Bless her. She's of sound mind. She's not particularly elderly, and she doesn't have any kind of identifiable kind of label to indicate vulnerability. But she won't mind me saying this, she's not financially literate, and she lives by herself, and so I would say she is vulnerable. But from a systems perspective, how do you identify that? It's a really, really difficult thing to do. But yeah, I would hope AI can really kind of step in and help crack that nut.
It is difficult, and I think transactional data has a part to play as well. There was as part of the session that we had, one of the examples from the group that we were talking around is how their mum had actually been sending large amounts of money out of her account, and it was quite unusual. It was quite an irregular pattern, and the bank had actually contacted her daughter and kind of highlighted this to them, and it kind of made them aware that she had dementia, and they'd very much been kind of focused. The family had very much focused on kind of health and making sure she was comfortable at home and had everything that she needed. Wasn't necessarily looking at kind of what was happening with her accounts. So I think the bank therefore spotted that, took action and reached out, and the family were really grateful that had happened. And I think that's a great example of where data is being used to spot something and ultimately provide the right care and support.
It's an amazing application of technology, isn't it? There's a fintech we had speaking at our Leeds conference actually last year, which TransUnion were also involved with, called Sibstar, and their whole propositions around people with vulnerabilities and almost giving like a power of attorney to another person over their financial decisions, and that technology can actually spot things like Alzheimer's before anyone's aware that they've got it, because of these patterns that it can see, which is absolutely astounding, really, isn't it? So just I want to get to some questions, because this is a fascinating discussion, and I think we could just carry on right to the end of this session easily without getting to some of these. So I'll just read a few of them out, and then if any of our panel want to jump in and answer a specific question, or feel free to type an answer in the Q&A as well. And obviously to the rest of our audience, if you've got any more questions, if you've got your hand up, please use the Q&A function at the bottom of the screen to type a question out. So in no particular order, so we've got a question from Julian, who's asked, does anybody have any thoughts on the use of behavioral analytics in the credit decisioning process as an alternative to, or in parallel with, the more established credit scoring approach? Also, is there a role for this in the ongoing management of customers? And Lauren's also asked, hi, can there be some industry standards to provide a package of data that is easy for lenders to use, let alone the consumer? We also had a question from Hardy, which said, would the panel consider borrowing/loans to consumers/SMEs related to open banking, initially payment aggregate information systems for current accounts, or the rising phenomenon of open finance, maybe more along the lines of wealth management, insurance, pensions, and maybe borrowing? So yeah, I don't know if anyone has any thoughts on any of those questions. Please take it away. I'm happy to repeat one of them as well if you need me to.
It's an interesting question around the use of behavioural analytics in the credit decisioning process. It'd be really interesting to speak to Julian around what he kind of means by that, in terms of I don't know if that's something that Plend has looked at, Sutherland, or it's something that you've ever considered.
Yeah, not currently. In terms of, well, yeah. Sorry, a poll's just popped up for me. Yeah, I mean, because we're very much on the basis of, like, we've got the categorization engine that kind of determines how you're spending, and we do blind underwriting, so we don't understand anything about who the customer is, and try just to specific on the data as possible. So yeah, kind of got me on this one, if I'm honest. If anyone else wants
Yeah.
to.
I guess the question is, what do we really mean by behavior analytics? So
Yeah.
that's a bit I would want to kind of dig into. I mean, open banking gives us access to a really rich kind of new kind of data set, and obviously you can infer behavior from that data set, and that I think is kind of a good sort of practical and kind of acceptable way of being able to kind of risk profile a customer. We talked about it earlier about rather than using it to make a decision, really kind of using it to kind of augment kind of what information we have from bureaus. So I don't think it's a one or the other. I don't think it's the established credit scoring, or behavior analytics. My general perception here and feeling is that one potentially helps the other going forward.
I agree. I think it builds on the picture, doesn't it? It's not a replacement of the picture. It's building up that broader data set and trying to create ultimately a more personalized experience for the borrower.
I mean, ultimately, we as lenders, it's the old adage, right? It's easy to kind of lend money, it's hard to get it back, and we need to kind of span and try and access as many data sources and as many bits of information as possible to ensure that it happens in the way that we want it to. So I certainly see a space for it.
I'd be really interested if Julian could expand on what he actually kind of the details behind that, because one of the areas where we've looked at behavioural analytics is more from a fraud prevention side. So looking at how people are applying things, the way that they're entering their details into that application, and actually is there an indication of a bot there or that it's potential fraud, and that's kind of how we've used or how we are using behavioural analytics. I'd be really interested if he means in terms of taking like how interactions across the finance products, different apps, and whether or not that would play a part, or applications for different lendings, or is it more on that kind of transactional analysis, and that's obviously something that we're already underway with and is being used by organizations like Blend.
Yeah, no, I would, just to back up what Simon and Caroline have said in terms of I wouldn't see one set of data as an alternative. I think, like Simon said, in parallel is the best way. And I think to kind of just jump on what Caroline just said, then we would never solely rely on open banking. I know that there are some lenders in the space that are doing that, but we don't see someone's credit hunger just from open banking, because if they've applied and been declined, we don't see that. And so that's where the use of both of them in parallel is ideal and required for a full appetite of risk. So I would say, yeah, if we want to add in more data, sure, but we wouldn't add in more data to get rid of something else.
Just to move things on then, and again, if anyone has any more questions, please put them in the chat. Please feel free to build on your original questions as well. So we've mentioned customer experience, but I thought we should maybe dig a bit deeper into that. Obviously, fintech as a space has, I don't know, I think historically had a bit of a focus on that drive towards increased efficiency. But obviously, it's really important for us to get friction right, I think, isn't it? And especially when it comes to vulnerability. So does anyone want to talk about customer experience? Maybe Sam, maybe start with you, and then I'm sure the other guys will want to chip in as well.
Yeah, I think we've kind of touched on it a bit. I mean, in terms of customer experience, is really important in terms of building brand loyalty. It's important as part of that vulnerable customer piece as well. And it's getting that customer experience right is really key. I mean, we took on kind of friction within that process. That's something that's really key to get right, isn't it? I mean, think of buy now, pay later. It's pretty much frictionless at the moment. Whether you see that as right or wrong depends on which side of the fence I think you kind of sit on, and whether you're actively using buy now, pay later, or maybe kind of considering it from the consumer harm perspective. I look at kind of other areas of friction within the financial services ecosystem as well. So kind of instantly think of strong customer authentication, and that deliberately added some friction into the process for the right reasons, to try and reduce fraud and to try and increase kind of the protection that pays have. that took years to implement, didn't it? I think it was 2019 it started, and then 2022 it actually finally got implemented. And we all get impacted by strong customer authentication every single day. Some customers and some merchants have a fantastic experience with that, and others don't. And frankly, you probably drop out at checkout if that strong customer authentication doesn't work. And from a buy now, pay later perspective, I think we know that regulation is coming in that area, and some friction, I think, to be honest with you, would be helpful. Certainly giving information to customers to let them know what they're entering into, the various risks and associated kind of implications of entering into those financial arrangements. So it's a very tricky thing to get right, isn't it? And it's something that can't, like, one person or one lender or one institution can't implement it themselves. I'm not sure whether this kind of entirely links back to Lauren's question about kind of industry standards and data packages, but there's a correlation there, I think, where if we're going to put some friction into the buy now, pay later process, for example, that needs to be an entire industry or regulatory-led change. If one provider puts some friction into their process and the others don't, well, people are just going to stop using that lender, aren't they? So I think there's a lot of points there, but customer experience, like if we implement friction into those processes, but do it with the customer experience and the customer kind of at the core of that, so we look at customer centricity, then I think it can be added in the right way.
For me, one of the best examples is obviously when you're trying to send a payment now, and where, you know, there's the check in terms of, is this the person that you want to definitely, are you sure? You know, that is, for me, is a great example of purple can't say it now. Purposeful friction that adds to the overall consumer experience. So it's adding in that extra step. It's potentially delaying being able to send that payment, but it's making sure the consumer really understands what's happening. And, you know, it does give you that point, oh, let me just check, actually, have I got the account details correct? So that for me is a perfect example. And it's how do we introduce and get those, you know, use those types of examples, you know, going back to what we were talking about, using all the data that we've got to identify things like vulnerabilities and looking at those personalized journeys, actually building out I can't believe I've been saying building out beneficial friction, I'll call it, you know, there's lots of opportunity there. So it's not necessarily saying, you know, we think there's a vulnerability here, but actually building in the additional steps, you know, extra checkpoints, you know, going back to what we were saying around terms and conditions, actually, could that be a checklist that the consumer has to work through to make it really clear that they actually understand everything that's being presented? I've seen some great examples recently, but there's absolutely, again, more that can be done.
I think also
just very, very quickly, I think customers are generally you know, fairly perceptive and fairly kind of, you know, happy to see good applications of friction in the example that the Karen just gave. You know, it actually enhances the whole process. It protects them. You know, they can see that protection's coming in play. So I think it gets received fairly well. But obviously it's those kind of unnecessary kind of, you know, friction points are the ones that we want to try and remove. Sorry.
Yeah. No, yeah, definitely. I think, yeah, it's more about from us as businesses, how we implement that friction, right? So, and it's kind of what we'll say, start like utilizing technology. So a friction point that we have is if we don't have enough transaction in one account, then we'll ask you to connect another account. That's good friction, I think, for us, because we're saying we need more information. It reduces our risk of fraud and that kind of thing. But if we were then saying, please send us bank statements, like that's not good friction, but like just connect another account through the technology that we already use, that's fine. For like, as long as it's simple and easy for the customer to interact with that friction, I think it's fine.
Just conscious of time, and I've got some more questions to get through, and I want to take this discussion in a slightly different direction now. Then, so Simon, question for you, obviously as our startup on the webinar, and as our new market entrant as well, I suppose. FinTech obviously has that almost unique potential, I think, to impact societal and behavioural change. Can lenders and FinTechs help to save the planet?
Yes, but I would say that. Look, I think the key here is scalable solutions. So the way I look at this is that kind of all the capital in the world is over here, but for us to reach our climate goals, our net zero objectives, it needs to be over here. It needs to be deployed to these kind of various spaces, and we kind of as a FinTech ecosystem, we need to develop those metaphorical pipes, if you like, that enable the capital to flow, and I'm talking about those origination platforms, those innovations that actually unlock the unserviced markets. Now the problem is, number one, there aren't enough of those pipes, and number two, for the pipes that do exist, not all of them are wide enough. So not enough of this capital is getting deployed to where it needs to. I guess to illustrate, from a consumer's perspective, there are some good examples of good green lending products out there, but these all tend to be capped, or they tend to be limited in some way. I think one bank, Nationwide, have 0% APRs on home retrofits, but only if you're kind of a nationwide mortgage holder, and they're limited because ultimately these products are either not profitable or they're not as profitable as traditional lending or traditional loans. But the problem is enormous, right? These products do not scale to fit the problem. If I talk about home retrofit, I think depending on where you look and which way the wind's blowing, I think there's between a 250 billion and a 300 billion dollar hole to fill. There's a massive funding gap, and we need to kind of engage private capital to be able to kind of fill that gap. But these existing solutions are simply not scaling to kind of meet the size of the problem. If they are to scale, these solutions, they need to be profitable, and they need to make the same risk-adjusted return on capital as kind of comparable investments, rather than just being based on subsidy. So yes, it can, in a word, but it's difficult, and we need to get those solutions to scale. But let's not forget, that whilst the problem is enormous, the opportunity here is immense. If we can create those platforms, if we can create those products that enable the smart allocation of capital, then not only are we kind of generating a return on that capital, but we're increasing living standards, we're kind of reducing living costs, etc. So the opportunity is huge.
And building on that, I feel like we're kind of we're looking forward now, certainly, and thinking about bringing Sam into this question. Definitely, obviously, Lenvi have been working on the consumer borrowing report for 10 years. How has the narrative changed in that time? And I guess question for all of you and you, Simon. What does the future look like in this space?
Let's start. I mean, Will kind of touched on it a bit in his presentation at the beginning, didn't he? 10 years ago, everything was focused on iPhone and mobile banking and social media, and very much the guidance that we had to lenders at the time was that they needed to get that balance right and needed to kind of focus on the interaction with the borrower through the most appropriate social media channels. And we kind of don't really talk about social media being a thing anymore. It's just ubiquitous, isn't it? So 10 years later, there's not so much emphasis on make sure you communicate with the right social media platform. It will actually make sure you have the right brand and the right customer experience. And again, Will touched on it, 38% of those borrowers who were kind of interviewed said that brand was the most important item, and second only to the interest rate. So we've seen a significant shift there in terms of what are the important reasons for people to select lenders. We've also seen very significant changes to the financial products. So again, 10 years ago, payday lending was a huge vehicle for lending money, and obviously regulation ultimately kind of put pay to pay lending, certainly to the scale that it was. And we're now talking about buy now, pay later, and obviously that's unregulated, but regulation is coming, and lenders need to kind of prepare themselves for that. So big shifts, both in terms of the consumer's attitude and also the different financial products that are available. I think it's fascinating with Simon and Sutherland on the panel in terms of the different types of lending that are now there, and without kind of dwelling on all the different options we're seeing people borrow money for a variety of different reasons today that weren't even considered 10 years ago, and that provides some opportunity for different lending solutions and different more personalized services and solutions.
Yes, so I guess from my perspective, the interesting point here is how the importance of green credentials of a lender seems to move, I guess, counter-cyclical to the macroeconomic cycle. So I think we saw in this year's report 40% of respondents say that green credentials of a lender are important when taking out a loan or mortgage, I think, which is down on previous years. I think it was about 50% in the previous report. And I think this pattern, where at times of financial hardship, the environmental concerns become, less of a priority. I think that pattern is becoming fairly well embedded now. And I would expect that to kind of be repeated in future economic cycles. The caveat, however, that I would put on that is the impact of innovation. So as I mentioned, our core product is a carbon linked loan, which ties the environmental credentials, of the loan to the core interest rate. So the idea being that the customer actually kind of has access to lower rate of interest, for funding those green initiatives such as home decarbonisation. To me, it would certainly be interesting to see if these sorts of innovations actually change the dynamic here, and indeed, whether green credentials eventually become or eventually move in sequence with that macroeconomic cycle. I'd certainly hope that's the case, but it'd be really interesting to see whether it comes out that way or not.
I think what we have today, and this will continue in the future, is just more consumer choice. So, and this is where brand becomes so important, and it's around the brand values as well. So I think, in the past we've seen things like greenwashing, and ultimately where potentially the brand's values don't necessarily align to the consumers, and there's been efforts to do that. I think because of the amount of information that's available now, the amount of choice that's available, it's more and more important that, like organisation like Simon's, where actually at the core of what they do, that's aligning to a value from a great deal of consumers. I think that's going to become more and more important. It's something that we're seeing already, and I think that will continue. And it's a great thing for consumers, ultimately.
Yeah, I think we see like the landscape of the industry has changed so much in the last 10 years, and it's just going to continue to change. I think also the amount of data that we're getting and consumers are now seeing, like, that are happy to provide firms with, is just increasing, and that's going to continue as well. So I think it's all about how we use that data wisely going forward for customer-based outcomes. I think regulation catches up, but it always needs to catch up. And so I think as firms, we need to make sure that we are at the forefront of what's happening, and making sure that we keep our customers at the base of what we do. And also, like Caroline and Simon have, like, our value-based firms and things like that seem to obviously make it impact more with customers than some potentially traditional based firms. And so I think, yeah, it's a positive, and it's also a challenge, because we need to make sure that we adhere to those and keep that at the forefront. But I think we're at a fast moving pace, and I don't think it's going to slow down.
No, absolutely not. And I think it goes back to that transparency to consumers as well. So alongside that data that's available to lenders and financial institutions, it's how do we make sure that we're presenting that back to consumers so that they understand it. So we're taking them on that journey with us. And that's something that absolutely, from our perspective, we are trying to do through our network of partners. So they've got the visibility of both the credit information that we hold on consumers, but also the transactional data, and making sure that that is served in a way that consumers can understand.
From a wider kind of societal perspective as well, like 10 years has changed a huge amount, hasn't it, in terms of our approach to talking about some of these difficulties. Like vulnerability just was barely talked about 10 years ago, and now it's actually at the forefront of lots of conversations, and we're looking at how we can use technology to help support and detect vulnerability, and that's a fantastic improvement in my eyes. And I think we look forward to the next 10 years to say, okay, well, what will we be talking about in 10 years, and how will technology continue to kind of improve that situation, whatever it is, and really benefit both lenders and borrowers.
Just we've had another question in the chat come through from Dylan, who has said, I believe providing financial advice to young people is a great opportunity for all of your businesses. And I know Caroline mentioned and touched on this. Linking to this inclusion piece, do any of your businesses plan to offer advice / support to the disabled community? So yeah, thinking about financial inclusion, does anybody got an offering there, or any plans in the works?
It's certainly part of the wider strategy for us. I mean, ultimately we want to target, all homeowners in the UK, and clearly a good portion of those homeowners do have some disability of some form. So it's imperative for our business to scale, that we can reach out and engage with that customer base, and that may be education. I'd actually say our product, whilst on the face of it's a loan, it's a fairly straightforward loan, there are features to it that we need to educate everyone on, disabled or not. It's so I think education is absolutely critical, is absolutely important, and I think the businesses that get that right scale, and I think the ones that don't probably get left behind.
I would absolutely welcome to work with a partner who would ultimately take the information that we can provide, or we can work with them to adapt it so it's suitable for different disabilities. I think it needs to come from a place of really understanding the requirements and needs, though. So for me, I would absolutely welcome and love to work with an organisation that was looking at something like that. I think some of the clients that we work with have got a really good approach, and certainly it's a conversation that we're having with some of the banks around further personalization. So how do we make sure that that's presented in the right way for different people? But yeah, I'd love to do more in this space.
Yeah, 100%. I think similar to what Caroline said, like we would definitely, we lend to anyone. It's more just about how we make ourselves accessible for them. And so that's some work that we are working on, and we will need to continue to work on, but definitely, yeah.
Yes, I'll conclude the agreements as well. I think anything we can do in that space is really good, and anything we can kind of help with lenders through the loan management platform in terms of that education piece, we're really keen to do.
Awesome. Well, we're nearly at time, guys, and this has been a fascinating discussion. Thanks also to Will for kind of setting the scene and taking us on that deep dive of Lenvi's report. Yeah, if anybody has anything else that they want to add, please jump in here before I bring things to a close. Otherwise, I'll wrap up, and I'll thank everybody for their time today, and we'll close things down on behalf of FinTech North. Has anybody got any final words they want to add in, or should we leave the discussion there?
Thank you very much for having us. Much appreciated.
Oh, thanks, Caroline. I really appreciate all the time that you guys have devoted to shaping this with us. So thanks so much to everybody for joining on this webinar and sticking with us right through to this time. Our next steps at FinTech North will be to produce a bit of a write-up, and we'll be posting the recording of this webinar alongside that, and we'll be sharing that far and wide with our community and all of our speakers as well. So yeah, I just want to thank everybody for joining us and being with us today virtually. And of course, we'll hope to see you at a FinTech North event soon. So thank you very much. And thanks to all of our speakers again.
Yeah, thanks for enjoying inviting us to be on the panel, Joe.
Very well.
Thanks all.
Thanks.
Thanks,
Bye.
everyone.
Bye.
Cheers. Bye.
Thanks, guys. Bye.